Before we begin, let's walk through our webinar platform together. Each of the buttons at the bottom of your screen relate to sections in the On24 console. The speaker view is where you will see our presenters throughout the webinar. The slide view is where you'll see the accompanying slides. You can resize these widgets for a larger or smaller view. You may also follow along with a PDF version of the slides that can be found in the Related Content widget. In the Related Content section, you can access any accompanying materials for this webinar. This includes a PDF copy of the slides and many times will often include related resources. Using the Reaction button, you can react to content throughout the webinar. Reactions from our audience throughout the webinar will float along the console screen. Use the Q&A section to ask questions directly to our speakers throughout the presentation. In the Speaker Bio section, you can find out more about our presenters, including their contact information. If you need technical assistance, please use the Help button below. Many times, technical issues can be resolved by opening the webinar in Google Chrome or refreshing your browser. Finally, the Evaluation button contains our post-webinar evaluation survey. Here is where you can share your commentary and feedback on the presentation. We hope you enjoy our free webinar. Now, let's get into today's topic.
All right, welcome everyone. We're so grateful to have you with us. I'm Ben Stapp. I'm located in Kalamazoo, Michigan, and have been a client manager with YPTC for the past 5 years. Prior to working at YPTC, I worked at a local healthcare nonprofit here in Kalamazoo after having spent the first part of my career in public accounting.
Good afternoon, everyone. I'm Christina Burr, and I'm also a client manager here at YPTC. I've been working with nonprofit organizations for more than 20 years. I started my career in public accounting as an auditor, focusing specifically on nonprofit audits, and then spent time in controller and CFO roles in both higher education and healthcare before joining YPTC in 2021. I currently reside in Grand Rapids, Michigan.
A little about your part-time controller. YPTC is a professional services firm that has specialized in nonprofit financial management for over 3 decades. With the goal of helping our clients sleep at night, our services include day-to-day accounting as fractional CFOs, interim controllers, and part-time bookkeepers. We support financial reporting, forecasting, budgeting, data visualization, and best practices, just to name a few. We have over 800 staff members helping over 2,000 clients from 13 regional offices and remotely throughout the United States.
Just a few quick reminders from the video that played at the start of the session. We'll be using automated attendance checks throughout today's session. When these pop up, you will hear a ding. Please click directly on the screen on the attendance check prompt. Our marketing and training support team members are here and will respond to CPE questions and other troubleshooting in the Q&A. But we would also like to hear your other questions today. And while we won't be answering questions during the presentation, we will have time to answer them at the end. So stick around with us till then. Finally, our slides along with our resources are available for download in the Related Content widget and will also be emailed to you after the event.
Being better than luck is not magic. It is about repeatable routines that remove luckbuster errors and omissions from the equation. This session will be a practical walkthrough of the most frequent financial statement errors that nonprofit auditors flag, and simple practices to catch and correct them long before the audit. Our focus today is on avoiding errors. If you want to start with a more foundational understanding of what an audit is and who is involved, please check out our session titled, Show Your Auditors Some Love. Our agenda for this session mirrors our learning objectives. First, we will look at why these errors show up and why auditors care so much. And then we will go through our list of luckbusters, easy to fix common errors. For each of these, we will share what it is, where it hides, early warning signs, and how to catch and fix them. By the end, we will share our audit luck checklist, a clear takeaway for you to reduce audit adjustments and surprises. So Christina, are you ready?
Yes, let's dive in.
Before we jump into specific errors, we want to level set. Most audit issues don't happen because someone made a careless mistake or didn't know GAAP. They happen because of how information moves or doesn't move through the accounting process over time. Policies and procedures sit at the heart of this process because they define how information is captured, reviewed, communicated, and retained over time. When they are clear and consistently followed, information flows predictably through the accounting process. When they are vague, outdated, or inconsistently applied, gaps emerge that eventually surface as audit issues. What we're going to walk through first is how these issues are created, often unintentionally, and why auditors consistently flag the same types of things, even at well-run organizations. This context will make the luck busters that follow feel much more practical and familiar. If you hear one thing today, most audit issues are predictable and preventable long before the audit starts.
Let's start by taking a look at a typical month-end close process. There are similarities with most organizations in that they all follow this similar flow: record transactions, reconcile and adjust, and prepare reports. The main differences comes within this first step, the recording of transactions, and the detail will be unique to your organization and specific accounting system. First, you want to ensure that all transactional activity has been captured. So looking to see if all sales, contributions, vendor payables, payroll activities, as well as payroll tax remittances and employee withholding have been entered. Ideally, you'll layer in enough time into your day-to-day processes to make sure this is happening in relatively real time. For example, if payroll is not integrated or needs manual allocations, performing those needed steps at each pay rather than waiting until the end of the month will save time and frustration during your month-end close. You will also want to do a quick glance over the general ledger to make sure that your recurring entries for things like prepaids, depreciation, and accruals have been entered as well. After you have determined all transactions are complete, you're going to want to reconcile your material accounts, starting with cash and working your way down the balance sheet. Based on your reconciliations, you might have some adjusting journal entries that need to be completed. After you have reconciled and entered your adjusting entries, you'll want to do one more review of the general ledger and trial balance to ensure that you have not missed any entries. And just a general note, all the transactional activities and the adjusting entries feed into the general ledger and trial balance. The trial balance lists the current balance of every account in your chart of accounts. So when performing your month-end close, use the trial balance as a lead sheet or a checklist to ensure all material or high-risk balances have a work paper that supports them, or at the very least, a note or point of reference for backup documentation. Ben, I'll hand it back to you to talk through how this all ties into the financial statements.
Thanks, Christina. Lastly, you're going to use that trial balance to create your basic financial statements. Your basic financial statements might include the statement of financial position or balance sheet, the statement of activities or income statement, and a report on cash activity. It's important to compare actual results to budgeted amounts and highlight the reason behind each variance in a memo or through the use of data visualization. Within this memo, you can also discuss any recommendations for process improvements. Investigating unexpected variances is a good way to identify and rectify errors on a monthly basis so they aren't accumulating throughout the year. A good business practice is to have a month-end checklist that has the date the task was completed and by whom. This way, you're able to ensure every step is being completed each month, and if there are any questions, you're able to go directly to the individual who's responsible for that step or task. Consistent month-end procedures are what keep issues from slipping through those cracks we just talked about, and are a critical part of our ultimate audit luck checklist, which we'll talk about later. A strong close process does more than produce financial statements. It creates documentation, supports judgment calls, and strengthens internal controls throughout the year. And most importantly, it dramatically improves communication with your auditors. When questions come up, you already have the story, the support, and the rationale. because you didn't wait until audit time to think about it. For example, if your organization is undergoing a capital project, keeping track of expenditures related to the project on an ongoing basis and reconciling them monthly in a work-in-progress balance sheet account will ensure that all costs are captured when the eventual asset or assets are placed in service. This will also facilitate having details ready for your auditor if and when they need them. Additionally, a documented checklist with ownership and timing is one of the simplest ways to reduce audit stress. Once you understand the month-end flow, audit prep becomes much less intimidating. Good audit prep starts with familiarity, knowing last year's findings and comments, understanding what changed this year, and documenting how your organization applies accounting standards. When these things are handled as part of the regular close, not just as a separate audit project, you reduce surprises and shorten fieldwork significantly. What do you think, Christina?
Well, as I mentioned earlier, I spent many years in healthcare finance, and we had a saying at the hospital, not documented, not done. And this also applies to almost every aspect of the month-end close.
Everything we've covered so far explains why audit issues happen, but now we want to get specific. Auditors tend to flag the same categories of issues over and over again, regardless of organization size or sophistication. In the next section, we'll walk through our luckbusters, 5 of the most common nonprofit financial statement issues that auditors flag, and show you exactly what they are, where they hide in the month-end process, early warning signs, and one simple routine to catch them before audit season. This is where better than luck becomes very practical.
We are fortunate to be connected to many helpful auditors here at YPTC, and so we polled them to determine what are the most common audit errors they've recently seen. And through that process, we heard some common themes. So the 5 most common errors mentioned were in-kind omission recognition and disclosure, restricted versus unrestricted presentation, contributions versus earned revenue confusion, stale or incomplete footnotes, and new and unusual transactions. Of course, this list is not exhaustive, and we're curious to hear which ones you have experienced, so drop it in the Q&A widget. For each of the 5 most common errors, we'll follow the same framework to help you understand and prevent it. So starting with in-kind contributions. In-kind contributions are one of the easiest things to miss because they don't involve the exchange of cash. Many organizations assume that if something doesn't hit the bank, it doesn't affect the financial statements. But auditors see this differently. Certain donated goods and services must be recognized in the financial statements in accordance with GAAP, and others must at least be disclosed. Missing in-kind contributions can understate both revenue and expenses. Auditors flag this because this can give a misleading picture of the organization's overall scale and reliance on donated resources. This issue hides outside the general ledger, often with the program staff or development teams. So the accounting team may not even notice or know that the activity occurred unless someone asks. In-kind contributions are non-financial gifts. So these are things that the organization receives in the forms of goods or services instead of cash. Some common examples can include materials and supplies, fixed assets or equipment, the donated use of facilities or space, and even advertising or media, and donated professional services. As mentioned, GAAP does require in-kind contributions to be tracked, especially when they are material, involve specialized skills, or would otherwise need to be purchased. They're recorded by recognizing both the revenue and related expense or asset at the same time based on the fair value. In-kind contributions are shown on a separate line on the statement of activities, and they're also reported on the appropriate lines or schedules of the IRS Form 990. And Ben is going to share what that presentation might look like.
Thanks, Christina. In-kind or non-cash contributions are reported on their own line in the statement of activities, as you can see on the left side of the screen here. They also appear in several places on the IRS Form 990, most noticeably in the revenue section. It's important to know that in-kind items will show up somewhere on your 990, depending on the type of non-cash gift. And one quick but important reminder, donated services are not reported on Form 990, even though they are recorded in your financial statements. That difference often surprises people, so it's worth keeping in mind. Not-for-profits may use either a table or narrative format, or a combination of both, to disclose the required information. This sample uses a table approach. Notice the descriptions provided for the valuation techniques and inputs, which are required under accounting guidance. For illustrative purposes, only one year here is presented. The footnote should include qualitative information about whether contributed non-financial assets or in-kind gifts were either monetized or utilized during the reporting period. Any policy about monetizing or selling rather than utilizing contributed non-financial assets. You'll see in this example that all items were utilized in programs. A description of any donor-imposed restrictions associated with the contributed non-financial assets. And lastly, a description of valuation techniques, which you can see described in the final column here.
This footnote example uses both a table and a narrative approach. At the top, you see a table that summarizes the type of non-financial assets the organization received during the year. Things like buildings, food, medical supplies, vehicles, and services, along with their dollar amount. This gives readers a quick snapshot of the non-cash support that the organization relied on. Below the table is the narrative disclosure. This explains the story behind the numbers. It clarifies what is an in-kind contribution, how those items were used, and whether any donor restrictions applied, and how fair value was determined. Using both a table and a narrative here is intentional. The table provides transparency and comparability, while the narrative explains judgment and context that the numbers alone can't capture. Ben, how have you seen this show up in practice?
I have an example here for a situation where implementing consistent in-kind contribution practices helped facilitate an easier audit. I was working with a client that accepted a high volume of supplies and equipment for potential use in training organizations in developing countries. They were recognizing in-kind contributions and expenses already, so they had a leg up on this luck buster. But what they found was that they were accepting anything that was sent their way and not using everything they received. This ultimately resulted in carrying a large balance of supplies with higher in-kind revenue and less frequent expenses. I helped them revamp their in-kind gift acceptance policy, which resulted in greater scrutiny of gifts before accepting them, thus reducing their higher in-kind income. This also enabled a better tracking mechanism for their in-kind inventory, resulting in the write-off of expired supplies on a more frequent basis. Both of these actions resulted in more accurate revenue and expense allocations, providing a better picture of the organization's actual needs and uses of resources, both month by month and at year-end for the audit.
The fix here isn't technical, it's procedural. A simple monthly question to your development and program teams can reveal in-kind activity early while documentation is still available. So add it to your month-end checklist. When it comes to in-kind contributions, documentation really is everything. A good rule of thumb is this: if someone is donating goods or services, we want paperwork that looks as close to a normal transaction as possible. That usually means asking the vendor to provide an invoice they would have issued if the goods or services weren't donated. The invoice should show their standard rate or price, the fair market value of the goods or services, and then clearly indicate the portion being donated or written off as pro bono. This invoice becomes our support for two things. First, the donation qualifies as an in-kind contribution, and second, that the value we're recording is reasonable and defensible. You also want to ensure that you have a gift acceptance policy and it's up to date and alignment with your mission. When identifying in-kind contributions becomes part of the regular close, auditors see consistency, intention, and support rather than last-minute reconstruction during fieldwork.
Next, let's look at another one of the most common nonprofit audit issues: restricted cash and liquidity. It is important to note that restricted net assets represent resources that are donor restricted in purpose or timing, regardless of whether they are currently held in cash, while restricted cash refers specifically to cash balances that are legally or contractually restricted for certain uses. As a result, an organization can have restricted net assets without having restricted cash on hand. This usually isn't about missing money. It's about how cash is presented and explained. Many organizations look at the bank balance and assume availability without fully separating restricted amounts or explaining limitations on use. Auditors focus on this because liquidity tells a story about financial health. If cash appears available when it's actually restricted by donor intent, grant agreements, or board designations, that story becomes misleading, even if total cash is correct. This issue tends to hide in plain sight. Bank reconciliations are completed, balances tie, and everything looks fine until somebody asks, how much of this can we actually use? Liquidity disclosures are often handled late in the process, which is why this becomes an audit time conversation instead of a month-end one. The good news is this is very fixable with one simple routine, which is another part of our audit luck checklist. At month-end, don't stop at reconciling total cash. Take an extra step to identify which portions of cash are restricted and why. That might be donor restrictions, grant terms, or internal board designations. The most effective prevention tool is a rolling liquidity schedule. This doesn't have to be complex. It simply tracks total cash, restricted amounts, and what's actually available for operations. When this schedule is maintained throughout the year, the liquidity footnote becomes a summary, not a scramble. Auditors see consistency, documentation, and intent, which dramatically reduces follow-up questions and last-minute adjustments. This information can be presented on the face of the statement of financial position, but a lot of organizations might want to see total cash there instead. An alternate option is to produce a supplementary statement. An example I have is when I worked with a client who had lots of restricted cash related to various time-based projects. Every month, to aid them in visualizing the cash available for actual operations, we prepared a schedule of restricted, board-designated, and unrestricted funds. We started off by listing cash and liquid investments by each account, as you can see here. This tied to the total cash and investments on their statement of financial position. Then, we listed out all restricted net assets by major program and their board-designated reserves by primary purpose, both of which tied out to their statement of financial position as well. These amounts were subtracted from total cash and investments to get total unrestricted cash. Their board looked at this supplementary report every month to keep an eye on unrestricted cash, which was often much lower than their total cash. Christina, how have you seen this come up with your work with clients?
What really resonates with me around this topic is that it can be more than just a presentation or audit issue. It can also be a strategic opportunity. And the example, Ben, that you just walked through, as you mentioned, breaking out restricted versus unrestricted funds gave the organization clear visibility. I've seen similar situations where having that clarity has really completely changed the strategic conversation. In one specific case I'm thinking about, having this information really changed the direction of the organization's planning. Once the board and staff were on the same page about what was actually unrestricted, the conversation shifted. And instead of just bringing in more restricted dollars, they could take a step back and look at the bigger picture and intentionally focused on unrestricted funding opportunities and other revenue streams.
This is a great example of being better than luck. One small, repeatable step that prevents a very common audit issue.
Common error number 3, contributions versus earned revenue confusion. And I saw some questions coming up or some comments earlier about this topic, so we're going to dive in a little deeper here. So there we go. The correct timing for revenue recognition for a nonprofit organization can be complex, and it does require careful judgment because not all inflows of resources are treated the same for accounting purposes. We need to consider intent and determine whether there are any conditions or donor-imposed restrictions, either purpose or time-based. This chart represents YPTC's interpretation of a summarized process for distinguishing exchange transactions from contributions. A key first step when reading through your agreements, ask yourself, are we being paid for delivering something in return, an exchange transaction, or are we receiving direct support to advance our mission, a contribution? If it's a contribution, the next question is whether it's conditional. A contribution is conditional when it includes both a substantive barrier and a right of return or release. Barriers may include requirements such as securing outside approvals, obtaining matching funds, meeting minimum participation thresholds, or delivering a specified number of units or services. And until those conditions are met, the organization does not have an unconditional right to keep those funds. And then finally, you'll want to consider whether any donor-imposed restrictions exist. Although restrictions alone don't delay revenue recognition, they do affect how the revenue is reported, such as whether it's limited to a specific purpose or future period. So let's examine this through an example. A nonprofit receives a $100,000 grant to run an after-school program, but the funds can only be kept if the organization delivers the program to at least 200 students. Until those sessions are completed, that requirement is a condition. So if cash is received in advance, the proper treatment at the time is to record a liability to refundable advance until the barrier is met, at which time the organization can then recognize that revenue. Now compare that to a donor who gives $100,000 to be used for youth programming next year with no requirements to tie to outcomes such as the number of youth served or activities completed, and no right of returns. That's a restriction, not a condition. The revenue is recognized immediately, but it's reported as with donor restrictions until the time or purpose requirement has been met. These distinctions drive when revenue is recognized and help ensure that financial statements accurately reflect both the nature and the timing of support received, while also remaining consistent with nonprofit accounting standards. Grant agreements often describe activities and reporting expectations, but they do not always clearly indicate whether funds must be returned if those requirements are not met. In such cases, organizations must apply professional judgment based on the facts and the FASB guidance to determine whether the agreement includes both a substantive barrier and a donor right of return or release. Reporting requirements on their own generally do not constitute a condition without additional barriers and a right of return. Clear documentation of that judgment supports the accounting conclusion and provides the clarity needed for your auditors and stakeholders. AI can support the analysis of grant agreements by helping surface relevant guidance and considerations, but it cannot replace professional judgment or careful evaluation of the facts. Conclusions should always be validated against authoritative guidance and with experienced professionals, such as the team at YPTC, who can provide additional expertise when needed.
I'll pause just a second here and let you all know again that we see your questions in the Q&A, but we will answer those towards the end of the presentation after we've gone through everything. So we're not ignoring you. We will get to those, so please keep sending those questions. Our next luck buster involves financial statement footnotes. Footnotes are one of the most common sources of late audit changes. Auditors flag this because footnotes provide essential context for understanding the numbers. If they don't align with reality, the financial statements are incomplete. Many organizations reuse last year's disclosures, assuming they're still accurate, but operations, debt, leases, and policies change over time. The fix here is mindset and another item on our audit luck checklist. Footnotes aren't an audit-only deliverable. They should evolve and be updated throughout the year. When changes are tracked as they happen, year-end preparation becomes confirmation, not reconstruction. While auditors are typically the ones compiling the final footnotes for the actual audited financial statements, the ultimate responsibility for all footnotes lies with the nonprofit being audited. Keeping a list of major footnote items from the prior year's audit and reviewing it on an ongoing basis throughout the year is a great way to prepare for the following year's audit. Leaving the preparation and review of footnotes until audit time results in delays and scrambling. Common footnote disclosures that require additional time to prepare include investment details related to valuation and risk, the breakdown of functional expenses, and reporting subsequent items. For each of these, understanding the information required, gathering it in advance of the audit, and proactively providing it to the auditors will facilitate an efficient and effective audit experience.
And finally, common error number 5, new and unusual transactions. Many significant audit adjustments come from transactions that are new or different. These items don't happen often, so teams rely on assumptions or often delay decisions, sometimes even until year-end. Auditors focus here because new transactions often involve judgment and disclosures that materially affect the financial statements. These situations often show up in a few common areas. How the organization is financed or structured, such as new loans, debt changes, or new affiliated entities. How revenue and funding are received, especially first-time grants or complex multi-year awards or unusual donor restrictions. How programs and operations change, like launching or closing programs or introducing new fee-based services. Also, how assets and liabilities are managed, including large purchases, leases, impairments, or legal settlements. And how people and policies evolve over time, such as new compensation arrangements, severances, or changes to leave policies. A common example we see is new funding. Maybe it's the organization's first federal grant or a complex new funding source. Everyone is focused on running the program, so the accounting decisions get deferred. Then at audit time, the team has to go back and piece together what happened and explain decisions that maybe were never formally made. A simple log on early discussions would have eliminated that scramble. Ben, I know you've seen this firsthand with some more complex financing arrangements. Do you want to walk us through an example?
Yeah, so I've worked through this scenario several times in the context of new market tax credits. Those who have been involved with a new market tax credit transaction know how complex these arrangements can be, as is exhibited in this funding flowchart. For those who haven't, new market tax credits are multifaceted financing structures designed to support capital investment in low-income or underserved communities. They often involve multiple funding sources, debt forgiveness components, intricate compliance requirements, and may even necessitate establishing a separate legal entity. Long story short, every new market tax credit arrangement involves numerous balance sheet accounts and often complicated monthly journal entries. So you want to make sure you're getting your debits and credits right. Communicating with your auditors as these transactions develop helps ensure the accounting is handled correctly from the outset and makes the audit process far smoother down the road. This is a good reminder that audit footnotes aren't just technical disclosures. They're where the story behind new or unusual activity lives. When something significant happens during the year, like a major construction agreement, the numbers alone don't tell the full picture. That context belongs in the footnotes. As you're reviewing or drafting disclosures, pressure test them by asking 3 simple questions. What's the context? By which we mean, what actually happened, and why is it different from prior years? What commitments did we make? By which we mean, are there future obligations, remaining costs, or contractual requirements that stakeholders should understand? And lastly, what are the future implications? By which we mean, how might this impact cash flow, liquidity, or financial flexibility going forward? This is also an area where copying last year's footnotes can create risk, because new agreements or changes mid-year may not be obvious from the face of the financial statements.
The best time to decide on how to account for something is when it happens, not months later. A simple log of new or unusual activities creates clarity, supports decisions, and eliminates audit time surprises. After walking through the luckbusters, the idea of being audit ready probably feels a little less abstract. In our final section of today's session, let's review what being audit ready really looks like and how you can prep for it throughout the year and not just at year end.
So before we define what it means to be audit ready, I want to pause and talk about something we see all the time: two very different audit experiences. A reactive audit is what you might be familiar with. It's characterized by year-end scrambling, trying to remember why decisions were made months ago, and pulling documentation together under pressure. Even strong finance teams end up spending nights and weekends reacting to requests. A proactive audit looks very different, but it follows the same standards and requirements. The difference isn't technical knowledge, it's timing and habits. Decisions are documented when they happen. Support is maintained as part of month end, not recreated at year end. What's important to understand is that auditors aren't asking for more in a proactive audit. They're asking for the same things. The organization is just ready for those questions a lot sooner. Everything we covered in the Luckbusters section is really about shifting from the reactive column to the proactive one.
Audit ready doesn't mean perfect books or zero audit adjustments. It means your financial information is consistent, supported, and explainable. One of the most important and often overlooked steps is ensuring your beginning balances match last year's audited numbers, including any audit adjusting entries provided to you by your auditor. When your team and the auditors are starting from the same place, everything that follows becomes much smoother. Ben, this is a good place to talk about how audit prep really becomes a team effort.
Yeah, for sure. One reason audits feel stressful is because finance is often expected to produce everything, even things they don't own. In reality, strong audits depend on collaboration. Program teams, development, HR, and leadership all play a role in providing context and documentation. We'll talk more about this breakdown and the responsibilities of each group over the next few slides. When roles are clear ahead of time, audit requests move faster, questions get answered sooner, and finance isn't stuck chasing information at the last minute.
So what should my team provide throughout the year? A common theme today is that preparing throughout the year significantly reduces the scramble at year end. A good rule of thumb is to build strong habits as you go, set documentation aside as it comes in, maintain support for key balances, and use consistent filing structure and naming conventions so your documentation is easy to locate when it's needed. It's also important to keep track of any governance or organizational changes throughout the year. This chart highlights some of the most important examples. First, let's talk about documentation you want to collect throughout the year. This includes things like lease agreements, as well as line of credits and loans, and these go hand in hand with your month-end close. While you obviously keep the original loan and credit documents, it's just as important to reconcile those balances monthly, since they're typically significant balance sheet accounts. You'll also want to track any new fixed asset purchases or disposals. Remember that fixed asset schedule we talked about earlier? This should be updated throughout the year as assets are added or retired, rather than waiting until year end. And finally, be sure to retain all grant awards and major contribution documentation. Any new or updated grant agreements or support for large contributions should be set aside as they happen. Auditors almost always ask to review these. So now let's connect this back to the month-end close process. If you're already doing a strong month-end close, you're actually collecting a lot of this support naturally. That includes schedule for balance sheet accounts, support for major revenue and expense accounts, monthly bank and investment reconciliations, and your full financial statement package. One last but very important thing that I'll say about this is about tracking your account variances. A good rule of thumb is that if an account increases or decreases by more than 10% over month unexpectedly, it's worth researching and documenting why. This does two things. It helps you stay aware of significant financial challenges during the year, and it puts you ahead of the game for the audit. Your auditors are going to ask you about variances that exceed their thresholds, and if you've already documented the explanation, audit prep becomes so much smoother. Ben, do you want to take us through the governance side of things?
Yeah. The next area of audit preparation relates to governance documents and any changes to them. There are several governance documents for which the finance team is responsible, including monitoring and documenting updates. These typically include accounting policies and procedures and cost allocation methodologies, which support the preparation of the schedule of functional expenses and are routinely tested by auditors. We've talked a lot about the responsibilities of the finance and accounting department. However, there are also audit-related items that fall outside of your direct ownership. These include the employee handbook, organization-wide policies and procedures, including those maintained by other departments, internal control narratives reflecting current processes and any changes. For example, if vacation time is accrued at year-end, auditors will verify that the accrual aligns with the organization's vacation policy, particularly if policies have changed due to staffing shifts, such as those experienced during the pandemic. Board minutes, which auditors typically request from the beginning of the audit year through to the end of audit completion. This allows them to identify any subsequent events that may require disclosure in the financial statement notes. And related party disclosures, including conflict of interest statements. These statements must be updated and signed annually and are routinely requested as part of the audit. These documents are often maintained by other teams or individuals, such as human resources or the executive director. Throughout the year, it's helpful to check in periodically to confirm whether any updates have been made and, if so, to obtain the most current versions. Many of these documents do not change frequently. However, board minutes and conflict of interest statements are notable exceptions, as board minutes are updated regularly and conflict of interest disclosures must be completed and updated annually. With all this being said, remember what Christina said earlier. If it's not documented, it's not done. Here we have an example of a prepared by client list, or as it's frequently called, a PBC list. You should notice that the first 9 items on this list are all the type of governance documents we just spoke about on the previous slide. These include bylaws, board minutes, loan agreements, and personnel details. As discussed, these items are not the responsibility of the finance team, although the finance team can collect them from others within the organization for supplying to the auditors. It's important to note that finance may also have more responsibility for these documents in smaller nonprofit organizations with fewer staff members. Taking a look at the next section, you'll notice how the elements of our monthly close process can help prepare you for the items the auditor will request. A properly established month-end close process should mirror the reconciliations and information that auditors frequently look for. For example, the grant schedule requested here is an item that should already be addressed and reconciled on a monthly basis. Some auditors will use an automated document exchange platform where both the auditor and the auditee can manage, track, and share documents with each other. The platform shows the due date and who is responsible for completing the task. However, if your auditor does not use a platform like this, we recommend using the PBC list to assign responsibilities among your team and track due dates and submission dates to the auditors. During fieldwork, auditors will want to talk with lots of folks and will ask for lots of support. Use the PBC list as a guide and there won't be any surprises. Additionally, providing auditors with access to key files through QuickBooks, Bill.com, Dropbox, etc. can take things off of your plate and streamline the entire process. This can be very helpful to the auditors and you as it reduces the amount of manual back and forth work for transaction testing purposes. Christina, do you want to add your perspective on how teams can help prep ahead of fieldwork?
Of course. Before field work starts, auditors will ask for two key things right away: your trial balance and the year-end general ledger. You'll usually see these listed first on the PBC list, like in the example we have here. One important call out, you will want to provide the final version. Auditors use the trial balance and general ledger to set materiality and to decide which items they're going to sample for testing. And if there are significant changes after fieldwork begins, that can mean larger sample sizes and in some cases, a longer audit timeline. Now let's talk about sample selections. In addition to your PBC list, auditors will select specific transactions to test during fieldwork. For each of those samples, you'll need to provide supporting documentation. That might be things like an invoice, a copy of a check, a grant agreement, or a bank statement, basically whatever supports the transaction itself. Another helpful best practice to keep things moving along is to prep your team before fieldwork begins. Let them know that the auditors might be reaching out and consider making an email introduction ahead of time. A simple email that lists your team members and what each person is responsible for can go a long way. It cuts down on lag time and keeps requests from bottlenecking with one person. It also allows auditors to reach out directly to the right contact instead of routing everything through you. And one last tip, include the best days of times for auditors' questions during fieldwork, setting those expectations up front. Everyone stays efficient and keeps things moving. Again, I see some really great questions keep pouring through, and we're going to get to as many of those as we can here shortly. But before we do that, your key takeaway from today is this checklist. And just another reminder, I saw this in the Q&A, I believe. The slides are going to be available for download, and you'll also receive a copy of the slides emailed to you after the event, along with the recording. So back to the checklist. None of these items are complicated on their own, but together they can dramatically reduce audit adjustments and follow-up questions and surprises. So just taking a look through this list, some reminders. Communicate early and often with your auditors. They are not your adversaries, and they will really appreciate the proactive and ongoing communication. This is going to help address early issues and avoid surprises later. Make your auditors your friend. Tie out beginning balances prior to the prior year and audited trial balance, so you're starting at the same place as your auditors. Complete a consistent monthly close using your established procedures and checklists. Capture and evaluate in-kind contributions, making sure to take the time to reach out to your development and program teams. Identify restricted cash and liquidity monthly. Know how much cash is available for day-to-day operations versus restricted for a specific purpose. Assess grants versus contributions when awards are received, and document the donor intent versus conditional promises to help facilitate accurate revenue recognition in real time. Review your footnotes periodically, not just at year end, and flag and document new or unusual transactions throughout the month and the year. And finally, organize support as you go. Don't wait for the PBC, and use a consistent filing structure and naming convention so things are easy to find. Once again, the theme is timing. Every one of these things happen before audit season, not during it. This is how the organization moves from relying on luck to relying on routine.
As a recap of everything we've discussed today, audit readiness isn't built at year-end. It's built month by month by turning predictable luck busters into clear, repeatable routines. Audit issues don't start during the audit. They're created during everyday, month-end decisions and routines. The most common audit findings are predictable, repeatable, and preventable when you know where to look and what to check. And being audit ready isn't about scrambling at year-end. It's about building clarity, documentation, and confidence all year long. Thank you all for your time today as we work through this session. If you'd like to speak with YPTC about how we can help your nonprofit, here's how to reach us. And be sure to complete the evaluation survey. Your feedback and insights are so very important to us. Again, thank you so much for joining us today. We hope you enjoy the rest of your day. And now we'll go through some of the questions that have been asked and answer as many as we can.
Okay, Ben, you want to just kind of take turns picking some here, and we'll get to as many as we have time for?
Yeah.
Let's see. Just give us a few minutes to get caught up.
See one question here asking about selling auction items and whether you recognize that as in-kind income as well as the auction income. And there is a more kind of complicated process for that. You typically would recognize the donation initially if it's a tangible item that you can get a value for as an in-kind donation. And then if you were to sell that at a gain at that point, that becomes a different type of income that you would recognize. So I think that is something that you've already kind of identified in that question, but that is typically how I would handle that situation.
I have a couple questions here about deferred revenue versus conditional revenue. So someone asked, could it be recorded in deferred revenue? When I think this is related to when I mentioned refundable advance. That's how our books were before I started here is what the comment says. And the answer to that is the appropriate terminology is refundable advance. But if you're capturing it in a liability, what you'll probably see is your auditors will change that verbiage in their presentation. But by capturing the liability, you're well on the right track. And then I'll actually just hit this next one because I think it's going to be pretty short. Someone asked, is requirement to return funds if not fully used enough to be considered conditional? So the requirement to return funds is going to be attached to something that you needed to do in order to avoid having to return those funds. So the return of funds in itself is typically attached to that condition, and that's what makes it conditional. I think I answered your question there. Because the lack of following through on that condition is what would trigger the return.
Got a few questions here on more on in-kind contributions. There's a question about a recommended threshold or dollar value for materiality for in-kind contributions. With that one, I would say how big of an impact is that having on your organization? The true purpose of recognizing in-kind contributions is so that those resources that you're getting are reflected on your financial records. If you were not to receive those in-kind contributions, what kind of impact would that have on your organization? So really that question is one of materiality. If it's a small amount of in-kind donations, it takes a great deal of effort to try to track and record. That might not be something that is ultimately material and worthwhile. But if it's a large, sizable portion of your overall operations, then it would definitely be worth recording those. So setting that exact value is something you're going to want to do in your in-kind gift acceptance policy. And then there's another question here about recording produce prices. So it says, we work with a food rescue organization whose produce we redistribute to our beneficiaries. Is that considered an in-kind donation? Again, this goes back to what I said with how significant of a portion of what your organization is doing are those food donations. So I worked with another organization that did the same thing. They gathered food from all sorts of for-profit businesses that would give them to them a day or two before they would potentially expire. They would bring those to their distribution centers and they would distribute those. In total, that added up to be a great deal of money that those donations represented. So what we would do is find the marketable value. You can go online, do some research, just find kind of what's the average for those types of items that you're receiving, and then keep track of those and record those on a monthly basis.
So I see a question here asking, if the organization is small enough that it doesn't need an audit, should we still be putting footnotes in our financial statements? And this is a great question, and I think it goes back to best practice for who your reader is. Which, if you don't have an audit, whoever your shareholders are, that could be your funders, your grantors, your board of directors, and I think always having some type of executive summary or memo explaining the context behind the numbers is really a best practice. As we mentioned in the one disclosure that we showed, where there was the table at the top, and then below there was the narrative that showed the story behind it. And when we do financials at YPTC, that's part of our basic practice or package, is to have a memo that really explains the story behind the numbers.
See another question here related to conditional contribution says, excuse me, is the requirement to return funds, if not fully used, enough to be considered conditional? In this case, no, because there are those two components of a conditional requirement. So you're going to have some sort of barrier that you have to overcome, and then the right of return. Most award agreements, if they're restricted, will typically have that same language in there about returning unused funds. That alone is not enough to make it conditional. There has to be that barrier as well.
Let's see here. For time, I see one that says, for time information, what happens when the organization doesn't do timesheets? How best to have this time information? So I'm assuming that you might be talking about in reference to capturing it for a grantor. So that's how I'm going to answer it, but feel free to pop some more information in the chat if you want me to go further. But often what we'll suggest is doing some type of time study or tracking of how time is being spent, so that you know how to appropriately post that to your different programs. If you're working with federal funders, there's certain requirements that are kind of outside of the scope today, but there's a NICRA allocation or calculation that can be performed. So there are some ways to still capture that information. If you're just trying to capture it for internal purposes, again, you can do a time study, so you can come up with an estimate, or you can have your employees, kind of keep track of how they are spending their time.
See a question here about who owns the approved budget. That is typically the board. The board's one that is approving that budget in your board meeting agenda and notes. So that's typically who would own the approved budget if there is an owner.
Is unrestricted funds subjected to external audits? And audit requirements can be different state to state and different depending on the type of your funding. So the national rule, I believe, is still, if you are over $1 million in federal funding, you are required to get what's called a single audit. Now, different states have different laws, and it's based on your total revenue, not necessarily your unrestricted audit or your unrestricted funds. So as part of the audit process, then yes, your unrestricted funding would be looked at in terms of internal controls and things like that. But it's really going to depend on your state requirements and whether or not you are receiving federal funding and what the thresholds are.
See a great question here. Do conflict of interest forms need to be completed annually for board members, staff members, or both? At minimum, it's board members. If you look at your 990, there are questions that pertain specifically to board independence. So when that 990 is signed and those boxes are checked, that is your board certifying that there are no conflicts of interest with known vendors or anyone else that they do work or business with. So staff members, it's probably more of an informal thing there, but at minimum, board members are the ones that are going to be signing those conflict of interest forms.
If a nonprofit has several grants where cash is to be used for that program, does the nonprofit need to show funds from each grant? So again, I'm going to interpret this question to ask if you have one program and multiple grants all going into that program, do you have to track that? So you're typically going to be tracking, your different program revenue and expenses by program, and whether or not you're getting into the details of tracking the revenue, you're going to want to show, yes, all that grant that's been attributed to that program. You don't have to show separate line items on your trial balance or your financials, if that is the question. But you are going to want to track how much money has come in, how much you've spent, how much has been earned, if there's any conditions required to it, and how much is still owed to you. So we always recommend some type of tracking mechanism of all the grants that you currently have and the status of those grants based on the things that I just mentioned.
Christina, I know we talked a little bit about single audits already. Did you already answer the question? Will we offer a readiness session on that?
I don't believe I did.
Okay, I think that's a great idea. And I would love to be involved with that presentation if we were going to do that. Just real quick, just to talk a little bit more about single audits. Those are just like a normal audit, but a little bit more detailed in their scope. They're really looking at the individual expenditures that you've made against any sort of federal funding. So everything we talked about in this presentation, you just want to pay extra close attention to what you're doing with any federal funds, especially when it comes down to documentation. You want all the backup details to be able to trace through any sort of expenditures from the point of origin to the point that it hits your general ledger. So I'd love to teach a whole session on that. And again, I think that's a great idea.
We have a question that says, my previous question about how this applies to a newer organization, fresh out of fiscal sponsorship, not having an audited balance, et cetera, how do we make sure we are ready for that? This is a great question. I'm so glad you asked it because we see this a lot. We deal with a lot of fiscal sponsor breakoffs, and we also just see organizations that maybe started as new and over time have gotten bigger, and now they need an audit, but their books aren't quite ready without, policies and procedures and things like that. So I would say, number one, make sure you have good, solid accounting policies and procedures in place. So whatever you're doing to clean up your financials, you have that support. That's the process that you're using. But then you want to just start with your balance sheet and make sure that you can substantiate those balances, that things are reconciled to the source documentation as you're able to find it. That is a really great starting point. You just like we talked about the month end close, going down your balance sheet and assuring that your liabilities, your assets all have supporting documentation, so those balances are verifiable. And then we know that whatever happens on the balance sheet, a lot of that activity typically then runs through your adjusting entries, is going to go through your profit and loss. So that's also going to help you get started cleaning up the profit and loss and making sure that you're verifying the accuracy of the revenue and the timing of a lot of the things that we talked about today.
Got another question here that says, at monthly board meetings, financial statements are presented and explained. Do we need separate year-end financial statements prepared? So what I would say here is your board is approving financial statements as they occur. If you do have final year-end financial statements that differ from what was presented in either December or June or whenever your year-end is, it would make sense to have those approved by the board as well. Just for posterity and to have that in the records that nothing significant has changed between what they originally approved and what was approved later. One thing you can do is, if you're presenting something like that, is to just have a supplementary schedule of changes. That's something I've done in the past. If there's nothing overly significant and it's just a half dozen items that have changed, providing a statement that shows what those are and what the explanation is would make that process a lot quicker and easier.
I'm just scrolling through to here to see what has been answered and what's new and what hasn't. Let's see here. Someone says, how wise is it to have unannounced internal audits? I actually used to be an internal auditor at one point in time, and very often those internal audits were relatively unannounced. I think it's going to depend on your organizational structure and what specifically you're auditing. You know, your team, you want your team to be able to have the capacity to answer your questions and to follow up. So I think that one is going to be like very unique to your circumstances.
See, a question here says, please explain internal control narratives. I believe we were speaking about this in terms of what is supplied to auditors per their request. Sometimes auditors will send a list of questions that you'll provide some information on related to your internal control policies and procedures. So I've seen this in the past. It's usually when you're going to have a new auditor, they'll supply a list of questions, and that's the type of thing that you're going to need input from other departments on. In general, your internal controls are going to be all laid out in your policies and procedures. So hopefully when that time comes, we're producing those internal control narratives and questions that, answering those questions that the auditors provide should be pretty self-explanatory and simple.
And someone asked, is it recommended to maintain separate bank accounts for contributions with donor-imposed restrictions? And again, I hate to go back to the depends answer, but I will say that I have seen funder documentation that requires this. I would not say that it's always the best practice. You just want to make sure that if it's not required by your funder, that you are tracking the cash that you're spending and how much of your cash balance is related to restricted versus unrestricted, because you do not want to find yourself in a situation where you've overspent funds that should have been restricted on items that didn't apply to those restrictions. So one way, you don't necessarily have to have a separate account if your funder isn't requiring it, but you will want to have a detailed documentation of what those balances consist of.
Got a new question that says, what happens when board statements are not GAAP and audit are GAAP? It is very difficult for the board to understand GAAP reports. So I think GAAP and probably accrual basis is what we're talking about here, accrual basis versus maybe cash basis. So internal statements, while they do need to be in accordance with GAAP in general, can be presented on the cash basis. So you can, January through November, provide cash basis statements to your board. I would typically make it clear that those statements are presented under cash basis. And then at year end, you can do some sort of reconciliation between cash and accrual basis. Some accounting systems will provide for cash versus accrual, so you can actually run reports out of the general ledger system that are in cash basis that you can provide to your board throughout the year. And then those will simultaneously be tracked with accrual basis accounting that you can provide at year end. So at year end, you'll also have to take a look at anything else accrual that you're not doing at that point.
Someone has a question that says, our third-party processor filed for bankruptcy and owes us for donations. We recorded the donations as cash, but now they may be tied up in bankruptcy proceedings for years. What is the best way to record this? This is a question that I would definitely want to have a conversation. If I were, when you're in your situation, would recommend having a conversation with your auditors, because there are very specific rules about disclosures and adjustments, whether things are measurable and likely to happen, and also not knowing the materiality here. But for internal reporting, a best case scenario might be for you to, at the very least, put some type of allowance on your books that you're not going to receive those funds, because it says we recorded the donation as cash, but they might. So if you haven't received the money yet, I'm assuming that you might have recorded it as a receivable in the revenue if the cash hasn't come in. And so you might want to put some type of allowance against that receivable if it's looking likely that it's not going to be collectible.
Got a couple more questions about in-kind revenue and how to record it and what types of items to record. So specifically, there's a question about software licenses. I would say if you're getting software licenses that you would otherwise purchase, it would make sense to record those as an in-kind donation. In terms of the journal entry, someone else asked about that. Typically, it's just a credit to in-kind revenue, and then the debit would be to whatever makes the most sense. So if you're receiving some sort of item that's going to go in inventory, like I talked about earlier, your debit would be to supply inventory, equipment, something along those lines. If you're just turning around and distributing that, like the food example we talked about earlier, your debit might just be straight to in-kind expense because you're receiving those items as revenue, and then you're turning around and distributing those out as an expense.
I'm sorry, I'm trying to get caught up here and see something. I forgot to check some of these off as already answered.
I see one here, how to distinguish between donor restricted versus internally purpose restricted. On your actual audited financial statements, typically anything that's board designated doesn't always go with donor restricted. Donor restricted is donor restricted. Those are hard and fast, but internally purpose restricted funds are a subset of an unrestricted fund. Those are set aside by the board. They're not restricted by a contract, but they're restricted by the board. So I would typically separate those on your internal statements. They would all just be part of your net assets at the bottom of your statement of financial position. So typically I would have restricted, board designated, and then unrestricted funds on those internal statements. We've got time for maybe one or two more questions here at the most.
Did you already answer the one, can you provide an example of expenses related to in-kind gifts? Did we talk about that one already?
A little bit, I guess it would depend. I'm not quite sure what that would be. You know, if there's other expenses that are part of the process for delivering in-kind gifts. So let's say you're a food bank and you're distributing food. Those costs are separate expenses that are part of typically the program. So, you know, if you're looking at labor costs, those are just going to be recorded as labor as part of that program. They wouldn't be a separate in-kind expense or tracked along with those in-kind donations, if that makes sense.
And I was thinking of this one in terms of, you know, something even like, say an attorney gives you some pro bono work that you, had it not been given as pro bono, you would have had to incur those expenses. And so in that case, you are going to record the revenue for the pro bono in-kind legal advice. And then you're also going to record the corresponding expense. So it's kind of a wash. But that was the way I was kind of interpreting that question. So I think now we've kind of come at it from a couple of different angles.
I see something here saying, please reshare the journal entry presentation for contribution with donor imposed conditions or restrictions. I think that was our slide with the walkthrough of exchange versus contribution, and then whether it's conditional, unconditional, restricted, unrestricted. As Christina mentioned, these slides will be available, and you can actually, I believe, download them currently with that widget. So if you can't see those, please reach out to us, and we're happy to provide those, but those should be available as part of the slides. I think we got time for one more question. Do you have anything else, Christina, that you see that jumps out?
Let's see here.
And if we miss any of your questions, please reach out to us with that contact information we provided. We'd love to answer these questions offline.
I think you said donor research. I think we're kind of at time here. But yeah, I think there's a few that are maybe a little bit repetitive, or we kind of addressed through other questions, but
there's a few that are very specific too. So I think those might be better asked directly with circumstances if you want to reach out to us.
Agreed. So, all right, wonderful. Thank you everyone for joining us today and for all of your wonderful interaction and the questions that you were able to put out there for us to answer for you.
Great. And with that, we will say our goodbyes and appreciate your time.